Hello and good afternoon. I welcome you to today's special webinar, How to Trade the Market Opening of the US Markets. My name is Jens Klatt, and I'm exclusively presenting this for you here for JFD Brokers. And in fact, it will be, one second, I'll just have to. How to Trade the Market Opening of the US Markets. That's my name is Jens beautiful. Klatt, and, I can hear myself well, so everything should be fine then in terms of audio here. And yeah, so what we want to do today is obviously have a look at the US market opening. And I can already say that the market environment itself it's difficult. It's really, really difficult right now. So all in all, the thing is that usually you could have started out long right at the beginning of this week. And oh, by the way, one second, please. I just have to. Okay. The thing is that all in all, over the last 20 years, from a seasonal perspective, the last 5 trading days of the year. So in fact, I consider this week right now to be the last trading week of the year. So in fact, in Germany, for example, closes already, if I'm not mistaken. Yeah, it's yeah, sure. If I'm not mistaken, it's next week on Friday, and their trading is only trading hours are only half the day. So it means that here Friday is nearly not a trading day at all. Then on Monday and on Tuesday in Germany, the stock exchanges are closed. And while I'm talking, by the way, here is the setup we want to consider once again today. So while the market is closed, then on Monday and on Tuesday, it's only open next week on Wednesday and on Thursday. It's a little different in the US. So in the US, I think the market is definitely closed on Monday next week, so Christmas, but it's open on the 26th. But with most European markets being closed on the 26th of December, chances are not that high that, especially over the holiday season here, that we get to see huge volatility. And by the way, one second, I just want to look up the dates here for future trading in the US. So next week, so 25th, it's closed, yes. 26th open, and then is there? No, okay. There's no restriction here in the US. So US markets will be open for regular trading hours. No exception here. But all in all, again, it should be a very thin market environment, and that's the reason why I consider this week, in fact, to be the last trading week of the year. And now let's come back to the seasonal pattern. So usually during the time span here between the 18th of December, so that was, by the way, on Monday, closing on now Friday, respectively, it's the 25th of December, but in fact, this day is closed, as already mentioned. So during the time span of the 18th till the 25th, even though this is the 22nd tomorrow, in the last 20 years, 80% of the cases, the S&P traded higher and made on average 22 points here, while losing on average something like 10 points. So it's, in fact, a very low volatile market environment. Usually it's a very low volatile market environment. And so with this in mind, usually we'd say, okay, well, then it's a quite simple thing, right? You just go long on Monday. All in all, I mean, this is the strategy. Now you have to adapt the stop level accordingly and so on. But let's discuss this a little later. So the thing is that all in all, it's usually a very bullish seasonal pattern. And now have a look here, for example, in the DAX, what happened. That's, by the way, what I just described is not just true for the S&P, but it's also true for the DAX, for example. So in fact, on average, from the 18th of December till the 25th of December, so till the 22nd in this case, in our case here. Usually the market is also over the last 20 years, in 80% of the cases, 177 points on average higher. It's trading 177 points higher, while the other 4 cases, the market lost on average 85%. I'm sorry, 85 points, and with the highest loss of 175 points. And so what you can already see is that this year will be really difficult here for the DAX especially to achieve that, because the market started out quite strong, and in fact I was long here. So I gave it a try on the upside. Unfortunately, was stopped out here, break even. Since after this consolidation, I just wanted to give the market some room to breathe here, knowing about the seasonal pattern. And then I was stopped out already on Tuesday here with this spike on the downside, which came, yeah, a little surprisingly, let's say. So I was just looking at the market, was wondering what's happening here. Same thing on yesterday, on Wednesday. So market crashed initially right after the start, pushing back, but then trading lower and accelerating on the downside here over the next hours of trading here into the afternoon, into the evening. And right now, obviously, here's a level which is quite solid resistance in the DAX in this case, making it at least, if we make it above that level, making it at least possible that we end the year here at 13,000, above 13,000 points. But nevertheless, the thing is that obviously the market is weak. It's not as weak as the DAX. The S&P is not as weak as the DAX here. That's definitely true. And in fact, if you look here, for example, at the daily chart, you can see the week started out here at this level, and currently we are trading slightly higher than the first tick here, which was at 2,682. So currently the market is trading 2,688. So all in all, so far the seasonal pattern still is in play, and in fact it's possible that we will forthright this story and also see a higher close here than the opening. And that's, by the way, one of the reasons why I only want to favor long engagements. That's something I did over the week. Once there was a possibility to position ourselves, I only traded the long side. If there was a short signal, I completely ignored it, because I don't want to be short in the current market environment, even though nevertheless the question is, why is the market that that choppy, or why has it trouble to really take off here, especially European equity markets? And I think the main reason for that can be found in the yield markets here. So this is the Bund future, the German Bund future, 10-year yield. What you can see here from Tuesday onwards, we've seen a quite huge drop. The same thing is, by the way, true for the US Treasury markets, where we also saw a quite huge drop. And in fact, the drop here in the Bund, the German Bund, was, I'd say slightly, but nevertheless, a little more aggressive than what we've seen in the US Treasury markets. And this is the main reason, in my opinion, why, for example, the euro had no big trouble to not just hold the region here around 117, but also push back above 118, and yesterday attacking the region around 119. So the thing is that here the current price action is showing that the yields in Europe are probably getting more attractive compared to their US pendants, and that means nothing more than right now we see some capital inflows in the euro, while we get to see some capital outflows in the US dollar, even though obviously we're not seeing aggressive capital inflows in the equity market. But this is something which people seem to avoid here, let's say. And so make long things short, the thing is that from a research perspective, I consider the current price action to be very difficult, especially in terms of what to expect at the beginning of the next year. Meaning there's a good chance okay. So And with this in mind, especially here in terms of the European markets, I think chances are quite high, and it's a chance given that here over the probably not the next day. So if we can make it back above 13,100 in DAX, everything should be fine, and we'll make it out of the year above 13,000. I'm quite sure that this will happen. But the start into the next year can be really difficult and push, especially European equities, especially the DAX lower. And in this case, results in the DAX attacking quite soon, the region around 12,800 points here. And this is especially true once the euro probably continues its current run here on the upside. So what's definitely interesting and worth mentioning here is if you carefully watch that we cleared the region around the highs here, which was considered strong resistance many times, and the ECB seemed to intervene every time the euro pushed against 115. So there was already a quite aggressive spike once on the upside. That was mainly due to the financial troubles in China in 2008 and 15 in August here, but also here in April 2016. And then we saw aggressive selling pressure coming into the market here after that. And then here in July 2017, the market finally broke above that level. It's right now stabilizing at this elevated level. We know that in the commitment of traders report, for example, here in Euro future, the market is aggressively long positioned. So in fact, we see the highest long exposure in the Euro future, Euro FX future here since 2007. And with this in mind, I think there's a good chance that, and this is an outlook for the next year already, for the next month at least, that Euro USD has a good chance to finally push back towards and also above 120 rather sooner than later, and probably break above the highs here, which were which can be found around September, around 121. And if you finally push above that level, I think there's further room on the upside up to 125 at least. If this happens, and we also can see also in the lower time frames right now, there's a huge negative correlation between the euro and the DAX. That said, I think there's a good chance that here a higher a euro would definitely result in the DAX being pushed lower. And so from this perspective, I think we should finally definitely focus on the S&P. If there are people out there, and there's plenty, I think, because the DAX is a very, very it's one of the most traded assets, in fact, in the CFD world, at least European-wide. If someone wondered where this weakness is coming from, while the S&P is presenting itself so stable here, well, I think one of the main reasons currently is definitely the euro. And what I also like to mention here, to emphasize, is that the S&P, respectively U.S. equity markets in general, are definitely probably capable of seeing a bigger corrective move at the beginning of 2018 onwards too. This could especially happen, and it's especially true once the market is losing its current steam here, which is mainly based on, respectively, due to the fact that there was this tax reform speculation. And it wouldn't come as a big surprise if now, after the tax reform speculations are diminishing, that this is this is finally one trigger to see, U.S. equity markets in this case, then seeing a corrective move here. Even though I think, again, from a seasonal perspective, in the upcoming days, respectively today and tomorrow, from an intraday perspective, we should definitely take long engagements into account here, and long engagements only, in fact, because this is the other thing. Even though I am very skeptical about the start into the next year, I still consider chances to be high that the Dow Jones finally sees an attack up to 25,000, and also the S&P pushing for 2,700 points here on the upside. So yeah, and this said, this is already the fundament of our research here, in terms of which side definitely to favor, even though we still have to wait till 4:15 p.m. German time. It's 3:15 p.m. GMT. And then we plan to trade the break out of this range, which develops then between 2:30 and 3:15 p.m. GMT. We plan to trade this in direction of the identified advantage. Again, this advantage, in fact, is identified thanks to this exponential moving average 10 here on a 50-minute time frame. So everything above that is bullish, as right here. And now, nevertheless, we have to wait, in fact, another hour or so. So from 3 or 2:30 p.m. it's another 45 minutes, and then we have to see whether we trade above that, and if we break in direction of the identified advantage, meaning breaking it on the long side, on the upside here. While usually you would trade the short side once the market trades below this exponential moving average 10 here on a 50-minute time frame. But again, what I just described to you, especially in terms of seasonality, makes it really difficult for me to not overrule my system here and not to say, okay, I'd really like to intervene here from a discretionary standpoint and only want to trade long engagements. And if a short side would be triggered, then I'd step back here and just leave the trade alone and just say, okay, I don't want to trade this. So yeah, based on that, let's come back here to this slide. Okay. So 1 second, please. I just have to double check something. Okay. Yeah, again, so let's come to the open range setup first. So the open range, you define it between 2:30 p.m. and 3:15 p.m. GMT. So you look at the high and the low. In fact, I just hope that this is working now. I wanted to prepare it before. 1 second, please. Okay. Was the wrong button. Let's close this here. Let's just have a look here. Okay, I'm not sure. Someone is writing that the screen is fuzzy. Probably it has to do with your with your parameters you're using here in YouTube. I'm not sure, but because here at my end everything is crystal clear. Even though I know that I had this problem sometimes. From time to time, I had this problem that the screen was in fact fuzzy. But nevertheless, I was capable of switching this by working on the parameters at my end to probably double check them at yours. Probably that has to do something with that. So now, again, let's give it a try. I want to try to open the MetaTrader here. So the reason I have trouble to open it here is because sometimes my system something like I need to hide this or to make a secret out of this. So this is my live account here. I'm trading for my clients. And now the thing is that I want to switch over to the demo account. And the reason I want to do that. Oh, by the way, what just happened? Hello, can you still see me? Can you still hear me? One second. I have to. The reason I want to do that. Okay, so everything should be fine. At least I hope so. So usually you should see everything and hear me well. I just hope that it is true. So this is a live account, but I'm not willing to trade the S&P today. So that's one thing I'd like to say here. So usually, in fact, my main focus is on the DAX and it's on the FX markets. And so what I don't want to do here is to give you an example how to use this tool here from the MetaTrader 4 Plus from JFD Brokers in a live trading environment, since I risk to, let's say, misclick something or so, and then you enter a position you don't want to, and it will cost you money. So that's one of the reasons I just don't do this. And that's why we're switching over here to of this it's much easier in to work out. So yeah, there we go. First, some lines. So what are these red lines you can see here? By the way, let me take this out here. What are these red lines? These lines are breakout levels. So in fact, these lines are the levels I use here. These lines are the levels I just described here. So where we define the open range. So it's an indicator. So if you want, you can easily send me an email, and I can just forward this indicator here to you. And with this, you can here type in the value when the period begins, when the period ends, when the box ends here. And so using this automates the process of how to show this open range. So in fact, I just want to look up here. Can you? No, I think it's very rough. So it's not possible to make it to somehow put a shadow in here or so. So what you can also do is you can, for example, use vertical lines and put them in the chart here to have what look like that. So to have the main trading hours of the spot market here shown in your chart, also something you can do here. So, and this is where the market closes, for example. And in fact, this is very similar. It starts to look very similar to what you've seen here. So some of you might have wondered, okay, which lines are this? So it's nothing more than the spot market trading hours. When Wall Street opens, when Wall Street closes, this is when the main volume comes into the market. It's at 2:30 p.m. till 9 p.m. GMT. No, I'm sorry. Oh no, it's PM. Yes, I'm sorry. Yes, it's PM. And this is for yesterday, while this is for today. And this turquoise line, for example, is the first tick at 2:30 p.m. GMT. It's just to visualize the first tick here, and in relation, if we're trading above or below the today's market opening here, the first tick. The deep blue line is the last tick at 9 p.m. GMT, while the red line here on the upside and here on the downside, the green line, are the daily high, respectively daily low of the day before. And it's just to visualize all this here and have everything together at first glance. And so now, what we want to do is, in fact, after having here, by the way, we can also duplicate this and place it here, and do this here. So what you can do now is the following. So first of all, you have obviously step one, define the open range. This is what's done automatically by these thin red lines here. Horizontal lines, by the way. So unfortunately, and probably this is something we should definitely change here, right? So if I'm talking about red lines, it makes definitely sense to have a red line here. Just one red line, let's say. So let's use dark blue here instead. Okay, so the red lines are showing, the horizontal ones showing these 45 minutes. We need to define the open range. And so click, click, click. Oh, sorry. And yeah, so what you do then is you put in here in this guy's purple moving average. This is the exponential moving average 10 on a 50-minute time frame. And with this, you can spot, are we trading above or below that, and where's the advantage? So are we trading above that? Great, then we're only going long and trade the breakout of this open range here, of this breakout area on the upside. And if we're trading below that, we're only trading the short side and on the downside. And that's in fact it here. And so now the question is, after seeing the open range here, and now the problem is that in fact we can't make this a topic here, since this webinar ends at 3 p.m. GMT, and the open range is ready at 3:15 p.m. GMT. So unfortunately, we're not capable of really formulating the open range here. But the thing is that I can nevertheless show you here how to place the order based on the open range from yesterday, if you want. And we do this here with the mini terminal. So in fact, we traded quite aggressively out of the open range here on the downside. So it was only the short side which was relevant for us. And then you can click here on this small green button, and you get the order type, which will be a sell stop. Then you have here the price, which is 2,679.1. I'm sorry, about 1 here. And you, this is really great. You might wonder, okay, what is the risk I'm taking here on this position? And how to calculate the lot size. This is a great feature of this mini terminal. So what you can use the equity here, or the balance, depends. If you have no position on running right now, it doesn't matter. Probably balance is a little better. But again, doesn't matter. You can type in equity, percentage of equity, let's say 1% here. And then you can say, okay, where's the stop loss? The stop loss is, as written here in the setup, it's above, in case of a short setup, the high of the range. So we use the upper level here, 2,691.6, which is 2,691.6. And then the take profit is, in fact, not mentioned here. The take profit is that you take out the position automatically at 8:50 p.m. GMT. So you're not placing any take profit levels or something similar. You only take out the position, manually if you want. So it's a time stop out if you want. If you're not getting stopped out before. Even though some parameters might say, hey, or some traders, not parameters, might say, hey, I want to place, nevertheless, let's say, an exit something like 5-1 away from the current entry price in terms of the risk I'm taking, because I want to be prepared for some kind of flash crash. So kind of a, let's say, fishing limit you would just place in the market to try to profit from such a let's call it a fishing move or flash crash or whatever. So just in case something like that happens, even though it's not likely, if it happens, well, you're definitely better off to have something like that positioned in the market, and then to see getting a fill, like let's say for 5R you're having then traded and you just made with the trade. But all in all, the rule says that you're closing out the position automatically or manually at 8:50 p.m. GMT every day. And so that's it, in fact. So you don't need to place this take profit level. And now we place the order. And this is the great thing. So you can see here, obviously, the stop is exactly placed here at this high. There is the low yesterday. And this is the interesting thing, look at the volume here. So the volume is adapted according to the width of the range, and then calculated based on you're saying that you say, well, I want to risk 1% of my current equity here. And that way, the order is, or the volume is calculated then. And yeah, and that's all. So now you just wait for the order to be triggered. In fact, that was yesterday. You can see here that obviously the trade didn't work out, so we weren't stopped out, but the trade was taken out somewhere here with a small loss. It wasn't huge, so we're probably talking about 1 point you lost yesterday or so. But so obviously, when you took out the order here at around 8:50 p.m. GMT, the market was trading above your entry point here. But this is the same thing you do over and over and over and over again, based on these simple rules I just described to you here. These, in fact, 3 steps get the job done. I want to show you what I mean by get the job done, because in fact, it's a highly profitable trading strategy, even though some might say that can't work in the long run. Before now questions arise, please feel free to join the website here of JFD Brokers. And 1 second. Where is it? Oh, I'm sorry. Yeah, that's definitely something which doesn't make sense. 1 second. So it's click. Where is it? First of all, I need the English one, this one, and then it's trading platforms MT4 plus or MT5 plus. It depends on what you want to use, and then I'm going with the MT4 plus right now. You have here the possibility to enter here to download this MT4 plus add-on package. In fact, you can also download the MT5 here too. And there you have the trade terminal respectively. What I just used is here. This is this mini terminal, which is very attractive for all the people here. Oh, by the way, I just don't know whether I'm allowed to put in links in the chat box. 1 second. I just have to double check this. Not sure if I'm allowed to do that. And probably it makes definitely sense to shorten the link also. 1 second. Here. Okay, and now let's see whether this works or not. No, that's definitely not true. Where if the strategy works for a large account, I will show you some stat on that. 1 second, I just give it a try. Oh no, unfortunately it doesn't work. So yeah, just join the website then from JFD Brokers. It's JFD Brokers. Okay, yeah, why not? Let me do it that way. 1 second, I'll just send it over here. Click. Okay, so I sent the link to you. Yeah, so you should see the link then in a few seconds here. So what you can see is all these add-ons. By the way, they only work if you're working with a demo account or a live account, depends from JFD Broker. So if you don't have such an account, it doesn't work. So this is the next step you have to do if you want to download this. You have to also download a demo account here, which can be done here also via the platform section on the same page. So we can see here, for example, MT4 plus, and then you can download here the MT4 plus platform. Apply for demo account or live account. Let me just see, where's the tab for this? Find out more here. Get started. So if you click on this, then you're directed over to the account opening section, and here you can just type in personal live account, or you can start up with a demo account, whatever you want and whatever might suit you first. And then you can use this add-on package here, and just give it a try, as I did here. 1 second, by the way. Where is it? Here. So And now, by the way, I want to delete this here too. So I want to delete it. Yes. So very simple. In fact, you can easily use also the order here and just scroll with it in the chart. So this is also very easy. So like for example, let's place here 2000. What did I say? 269.1 or so, I think. Matter. I just placed the order. So here it is. And I've already deleted the initial order, but here you can see that you can just scroll with it in the chart, which is really, really comfortable because I just imagine all of the guys here listening to this right now and using the MetaTrader 4 usually see this order window, which is not even offering all the order forms, order types, or order forms here you can use or you can find in this mini terminal. So while you have here, for example, pending order, buy limit, sell limit, buy stop, sell stop, and that's it, you can here choose between, where do we have it here? Stop loss. No, I'm sorry. Here, I'm sorry. Buy, sell, buy limit, buy blah. And then you also have the chance to work with OCO breakout and OCO reversion orders. Especially the OCO breakout order is very interesting because, as you can imagine, if you see the market here trading in this range and not breaking out on one or the other direction, and you just, let's say, have to leave. It shouldn't happen, in fact, not when you're intraday trading the market, but let's say you just have to I don't know, open the door because someone is ringing or whatever. And so you just don't know in which direction the breakout will occur. Then you can easily place such a OCO order here, which means one cancels the other, meaning if one order is triggered, the other is canceled immediately. And you can easily adapt the setup here to both sides, to the long and to the short side, because everything is predefined. So you open the trade. Let's say you have the advantage on the short side. You trade the open range breakout then with a break of the open range on the downside. And you can also place this with an OCO order. You can place an order at the same time saying I'm going long once the market triggers the upside here and breaks out the open range on the upside. And this, on the other hand, deletes the short order and the other way around. And yeah, so in fact, it's a beautiful tool. So this tool alone makes it work, makes it worth here. Oh. To have a deeper look at this MT4 Plus in this case. And now there was nevertheless, this is purely technical, even though you can see that this already brings a huge advantage, especially for short-term traders. So just to have an idea here, like you have the mini terminal, it makes it also possible to predefine, for example, the lot size you plan to trade, the stop loss level. Like let's just do this. Let's work with a stop here of 20 pips or points and 60, which is huge. In fact, we were talking about the S&P. And I'll look at the following. We're currently trading at 684 nearly. Okay, you click on this, boom, and everything is placed. So you click on this, 20 points lower, you see the stop because you bought, and you have to take profit 60 points away from the entry course. Here with the volume you decided to buy, this is the lot size. And that's it. So here you can find the commission, and that's it. So it's very, very fast, especially for ultra short-term traders, let's call them. So those traders who say, okay, I want to scalp the market, but nevertheless I'm purely discretionary trader. And by the way, if you click on this here, by the way, you can see that you can't see the take profit, but here's the take profit. You can also choose to change it here, for example. Okay, so and change the take profit based on your preferences, fixed price, percentage of equity, and so on, break even, and so on. So this is, by the way, also a function which is really great for those who will probably say, hey, how can I use this here in terms of the stop? Well, you can say if the market moves your direction, place the stop to break even. So this won't work right now since the market is not trading break even right now. So, but dipping against us. Nevertheless, you can see that this is working really fine and very fast, especially for ultra hardcore scalping guys who don't want to waste any time here. But nevertheless, the question was on the performance of this strategy, and if it's only suitable for big accounts, which is definitely not the case. So 1 second, please. I'll just get you something here, a chart, which is showing the performance of this simple strategy, even though profitable strategy. And here, oh, does this work? So we've presented this together with a guy called Stefan Frichowski. He's also working exclusively for JFD Brokers. He has a PhD in physics and is real great in terms of programming strategies here. And then drawing, let's call it consequences out of this here in Excel, for example. For example, here showing a strategy which I just presented to you. So in fact, this is the equity curve for a backtest of this strategy here, simple strategy. 1 second. Oh, it's not open anymore. Okay. Click. So if you place in these parameters here in an expert advisor, for example, and you just trade this through over the last 7 years, you get a very, very great result out of this. And in fact, it's highly profitable. You can see here the win rate, for example, it's 47%, but you can also see the average profit, the average loss, showing that the so-called payoff ratio, that's the ratio of those two components here, is 1.3 to 1. In combination with a hit rate of 47%, you get an expected value of the strategy of 8 cents per euro you risk, meaning nothing more than, let's assume you're trading a 1,000 euro account instead of a 100,000 euro account. That means nothing more than you say, okay, I'm risking 1% of my equity here, which in case of a 1,000 euro account is 10 euros. So some might wonder now, okay, how can I trade 10 euro risk, 10 USD risk or whatever in a 1,000 euro or USD or whatever account? How is it possible? Well, thanks to micronization, everything's possible today. So many brokers, for example, JFD, are offering microlots. Microlot offering means nothing more than you can go as low as 1 tick is 10 cents, equals 10 cents. And this means nothing more than you can easily scale down the position size to a level where you can also adapt the strategy to a 1,000 euro account, for example. So small accounts then. And I want to come back to the expected value. So if the expected value says it's 8 cents you make on average per every euro you risk, it means nothing more than you're making, in this case, 80 cents per 10 euros you're risking. If you're trading a 1,000 euro account, it means nothing more than if you're trading a 100,000 account that you're making 80 euros per 1,000 euro risk, 1% risk in terms of 100,000. It's 1,000 euros. So now one might wonder, okay, isn't that a little bad? Because if you're aiming for, let's say, 80 euros and then you're risking 1,000, usually it's the other way around. I've read this several times on external websites. Well, don't get this wrong. That's not what I said. The expected value has nothing to do with the so-called payoff ratio. So what you're talking about, in fact, when you get this idea here of risking 1,000 euros to get 80 or 80 cents per risking 10 euros, is that you think I was talking about the payoff ratio. This is the ratio, again, of the average profit through the average loss. In this strategy, you make €1.30 on average for every euro on average you lose. So this is what you were talking about. The expected value, in fact, has nothing to do with that. So if you're considering the expected value, again, and I want to write this down here, that makes it possible to draw some, I'd call it beautiful conclusions for your overall trading. But let me first write this down here. So average loss. So we have, let's say expected value is EV. The average gain, again, It's 1.3. So by the way, I've already divided it here. You can see 1.08. So I've divided those three, and then it's 1.3 to 1. So don't be surprised to see that right now. And then you subtract 1 multiplied with 0.53. And the result is, in fact, if you type this in your calculator, oh, by the way, it's an English webinar. So that's why we have to place dots here. So in Germany, we're working with commas in this case. But yes, so that's right. And it means you'll make average 8 cents, €8 per €1 you risk per trade. So, and this in mind, you can see that even though you might lose, and this is, by the way, not that unusual, so using in a little more than 50% of the cases, you're all in all winning. It sounds ridiculous, but it's exactly what it is. So because the strategy is profitable, the strategy makes you money the long run, and it's we're not trading just once or twice or 10 times, but we trade it over and over again. And as you can see here, the number of trades in this example is 1,347. So you're doing this 1,347 times, and on average, you're making 8 cents per every euro you risk. So meaning you multiply you multiply this number here with the expected value you have, and then you have the overall amount of money you would have made. It's not that we can guarantee that the strategy will perform similar in the future. That's not the case. But, and this is the thing, it's a high probability that it performs well in the future too. Because, and this is the thing, it's easy. You don't have many parameters to change here. So you can change, okay, yeah, you can change the open range. But this is the thing. The concept of trading the open range goes back to a guy called Toby Crable. It's not that he invented it, but he found out that there is a certain pattern occurring over and over again. And he found out that this happens in the 80s, I think. So, and this is a strategy which not just works in the S&P, but it's also working in the DAX. It's also working in the Bund future, for example, so treasury markets, and also in blue chips. Like try this in Google or Apple or whatever. And the thing is that here, the open range, to have an open range which is too long, is just not very useful, I'd say. So I'm talking about the, in this case of the S&P, of the first 45 minutes of the trading day. So this is when the market finally has found some kind of direction. Was there already some sellers coming in, some buyers coming in, pushing the market in one or the other direction? The market had the time to see whether there is more demand than supply or the other way around. And that way, the market already defined the range in which it was trading, and where you can then say, okay, if we are now breaking out of this range, it's not unusual that the market will continue to trade in direction of the breakout, respectively taking on momentum in direction of the breakout. And that's something which, in fact, Toby Crable found out. And that's something where the open range itself, yes, you can manipulate it, but nevertheless, if it's working, let's say, for 45 minutes, it should also work with the time frame of 40 and 50 minutes. So within the neighborhood, it should also generate a positive result for your trading. Also, in terms of identifying the advantage, if you do this here in a rough way via the Dow theory, seeing a sequence of higher highs and higher lows, working with one second. I think it's better if I give you a chart to this, or respectively a graphic. I've prepared a graphic here for my students in my online course. One sec. It's here. Take some time. And now let's see. I think it's here. There we go. So It's a sequence of higher highs and high lows, for example. And then you say, okay, here you have the distribution area. This is usually the region where, for example, market participants considering this to be an overvalued area to dump their position, which they accumulated already here in a region which they considered undervalued, and where they try to anticipate the break to new highs, and where they had to find a region where to accumulate their volume. So we are not talking about retail traders building positions that way, but we're talking about institutional players. So professional traders, for example, working at prop trading firms and so on. This is one trading approach. It's some might call it old school. Nevertheless, it's something which stood the test of time here for over 100 years. And so I'd say it can't be that wrong then. And so the thing is that here you can easily formulate an advantage here, even though what we are doing here, and in fact makes things much easier, well, we are working with something which you can't manipulate either. It's the 50-minute EMA 10. And it's giving you a very good and very, very fast idea of where the advantage can be found here. Why don't we work with a EMA 50 or so? Well, EMA 10 works. Let's put it that way. By the way, EMA 50 also works, but it's generating a different result. I think slightly worse than that. But you have also to see, I mean, if you're working with an EMA 10 here and you increase the EMA up to 50, this is you're working by 5-fold here. So this is huge. I mean, this is enormous. It's completely changing the strategy if you want. Same is true for, let's say, going down with the EMA to 2 or so. So also here, if you can prove that it's working in the neighborhood of, let's say, an EMA 8, EMA 9, also in an EMA 11, EMA 12, and EMA 10 gets the job done, yes, let's call it perfectly, or you have a positive, very good result, better result than when using the EMA 9 or EMA 11, even though both of them still can generate a profitable result, you go with EMA 10, right? And so there are not many parameters you can manipulate here. That's what I want to talk about, what I wanted to say. And that's one of the reasons why this strategy is such a strong weapon, I think, in the arsenal of an intraday trader. It's easily duplicable. You can use it in many, many markets which have this tendency of see high volume and forming kind of an open range. You can adapt this to the FX markets, for example. In the FX markets, we can talk about the so-called Asia range breakout. If you probably have heard about this concept, it's in fact the same. And if you combine all this, you have a very, very strong basic strategy. And now the target is, in fact, and that's what I want to come to here, the thing is that if you know that the strategy works and it's a robust approach, well, what you can do is easily, you can try to optimize the expected value. You know, and this is also giving you some confidence in trading the strategy. But on top of that, you also know what to expect and then what to aim for. Well, you aim for get on average, let's say 10 cents per euro you risk. So meaning you have somehow find ways to probably cut your losing trades shorter or let your winning trades run a little more, or let's say do some better research here to find strong resistance, respectively support regions in the chart better to somehow get the expected value increased. And you can see that this is something completely different from in fact, it's something completely different here. When you look at several other trades, let's say, looking at the charts. So it's not unusual that many people want to find out whether the market now goes up or down. In fact, people who know that their basic strategy works don't care about this. They don't care if the market goes up or down. They have a strategy, they have a setup, they just trade it. And then the target is to increase the expected value, to optimize it. And if the market is moving against them, then their target should be to somehow get out of the position before the complete loss is reached, even though this wouldn't destroy the overall trading approach. while somehow making the average gain bigger by, let's say, for example, let the market move a little more, migrate it into the next time frame or so, and try to increase the average gain here of the trading approach. Yeah, and so that's it on the stats here behind this approach, and really showing that it's working. So one other thinking. I think this depends on which strategy you're trading. So the question is, if you don't hit your target today, would you advise leaving it overnight, or have to close the position and do it all over the next day? So this depends, in fact, on this trading strategy and on the current market conditions. So let's put it that way. I'm also trading an approach, systematic approach for my clients, which I manage this way, that I say, let's say 9 out of 10 times, I go with the system and I don't intervene at all. And then there's one time when the market conditions are in my favor, the position is running really well, and we are probably approaching a very significant resistance line where I say, hey, if we make it above this level, there's some further room on the upside or on the downside. It depends on whether I'm long or short. And then it could happen that I leave the position open overnight then. Yes. And I could give you, in fact, some examples on this when I did this in the past, some which worked out really well, some didn't work out that really well. So then the target is to somehow nevertheless get an optimal closeout out of the position. So that here, in relation to the trade, which would have been closed with a bigger gain, for example, the difference between the first position, which was already stopped out, and your position now, which aimed to anticipate a bigger move here, to don't let this gap widen too much, let's say. But it's really difficult to in fact give a general advice here. But all in all, yes, it finally comes down to there are occasions when this makes sense, even though most of the time you should stick with your system, which you know to be where you know that this is a profitable approach here and has a positive expected value. Okay. Yeah. So in fact, that's it. So it's 3 p.m. GMT. In the next 50 minutes, we will finally have the open range then opened. So as you can see right here, the S&P has some trouble. Nevertheless, by the way, also trading here below the purple line, meaning nothing more than if this continues, then based on the open range, which is right here between 2,681.3 and 2,686.7, he would trade the break here on the downside, even though I'd intervene here and say, no, I don't want to. I'd want to step back here. And from such a short engagement, since from a seasonal perspective, it's more likely that the breakout on the upside shows some more strength if it happens. Respectively, if the breakout on the downside occurs, as it did yesterday, for example, it's not likely that the market will continue drifting lower or taking on momentum here on the downside aggressively. And that's one of the reasons why I want to step back right now from for seasonal reasons here, from short engagements. Yeah, and so that's it from my end. Happy trading. Watch your stops. I wish you Merry Christmas, Happy New Year. All the best for 2018. Yeah, and hope to see you next year here again in those special webinars. Yeah, take care, see you, and bye-bye.